Today, we're reverse engineering credit scores, the opaque algorithmic overlord that determines whether you can buy a house, rent an apartment, or get a decent interest rate on literally anything. Not the pay your bills on time advice from credit repair companies, but the actual FICO algorithm where utilization ratios matter more than payment history. Closing accounts tanks your score, and you realize you're being rated by a black box system that treats your financial life like a video game designed by sadists. 3 credit analysts, 1 former FICO engineer who signed an NDA and regrets everything, and 45 minutes of pure scoring system trauma. I'm Jake, and someone's creditworthiness is definitely a lie.
I worked inside Experian for 8 years. 8 years, the public thinks credit scores measure how responsible you are with money. Reality, they measure how profitable you are to lenders. The algorithm is optimized to predict loan profitability, not financial responsibility. Someone who pays off debt quickly is less profitable than someone who carries balances and pays interest forever.
My job is analyzing FICO algorithm behavior through statistical modeling. You know what I discovered? The system punishes financial health. Pay off your student loans, score drops. Close unused credit cards, score plummets. Have no debt, your credit invisible and treated like a risk. It's mathematically insane.
I helped build parts of the FICO algorithm. I can't tell you everything because of NDAs, but I can tell you this. The scoring model has hundreds of variables that interact in ways nobody fully understands anymore. Machine learning components make decisions that the original engineers can't explain. We created an AI that judges humans, and we don't know why it makes the choices it makes.
David, guide us through this algorithmic nightmare. Alex and Rachel, prepare to explain why mathematics became our financial judge, jury, and executioner. No mercy, no build credit responsibly platitudes.
Let's start simple. What is a credit score supposed to measure?
It's supposed to predict the likelihood that someone will default on a loan within the next 24 months. Higher score means lower risk, lower score means higher risk.
That's the marketing version. What does it actually optimize for?
Lender profitability. The algorithm identifies people who will carry balances, pay interest, and generate fee revenue without defaulting. Perfect customers pay minimum payments forever. The score optimizes for profitable customers, not responsible ones.
Explain the 5 factors that supposedly determine your score.
Payment history is 35%, credit utilization is 30%, length of credit history is 15%, credit mix is 10%, new credit is 10%. Sounds straightforward until you realize each category has dozens of subcategories that interact in unpredictable ways.
Why is payment history only 35% when it seems like the most important factor?
Because perfect payment history doesn't generate revenue. Someone who always pays on time but never carries a balance isn't profitable. The algorithm weighs utilization almost as heavily because that's where the money is made. It's not measuring creditworthiness, it's measuring profit potential.
Break down credit utilization. Why is this so important?
Credit utilization is how much of your available credit you're using. Keep it under 30% for good scores, under 10% for excellent scores. But here's the insane part: 0% utilization can hurt your score. The algorithm wants to see you using credit, just not too much. It's a Goldilocks zone designed to identify optimal profit targets.
What happens when someone pays off all their debt?
Their score often drops. Pay off a car loan, score drops because you have less credit mix. Pay off credit cards completely, score drops because 0% utilization suggests you're not using credit. Pay off student loans. Score drops because your average account age changes. The system punishes financial responsibility.
Explain the length of credit history factor. Why does closing old cards hurt?
Your score considers the average age of all your accounts. Close your oldest credit card and your average account age drops, which hurts your score. Keep unused cards open and you might face annual fees. It's a catch-22 designed to keep you trapped in the credit system forever.
What about credit mix? Why do you need different types of debt?
The algorithm likes to see you managing different types of credit cards, auto loans, mortgages, student loans. Having only one type suggests limited experience with debt products. So being debt-free or having simple finances actually hurts your score. You need to be indebted in multiple ways to be considered creditworthy.
How do hard inquiries work? Why does applying for credit hurt your score?
Hard inquiries happen when you apply for credit. Each one can drop your score 5 to 10 points for up to 2 years. The logic is that people desperate for credit are risky. But here's the catch: you need to apply for credit to build credit history. It's like needing experience to get a job, but needing a job to get experience.
What about rate shopping? Can you apply for multiple loans?
There's a rate shopping window, where multiple inquiries for the same type of loan within 14 to 45 days count as one inquiry. Sounds reasonable until you realize the window varies by FICO version. Lenders use different versions, and nobody tells you which version they're using. It's deliberately confusing.
How many different FICO scores are there?
There are over 50 different FICO score versions, plus Vantage score models. Auto lenders use FICO Auto 8, mortgage lenders use FICO 2, 4, and 5, credit card companies use FICO 8 or 9. The free score you see online might be completely different from what lenders actually use. It's like having multiple report cards that all measure different things.
Why don't lenders use the newest FICO versions?
Because switching costs money and they're comfortable with models that have proven profitable. Mortgage lenders still use FICO versions from 2006 because that's what Fannie Mae and Freddie Mac require. Your score is being judged by decade-old algorithms that don't reflect modern financial behavior.
What happens to people with no credit history?
They're credit invisible. About 45 million Americans have no credit history or insufficient history to generate a score. They're treated as high risk by default, even if they have stable income and savings. Cash-only lifestyles are penalized by a system that requires debt participation to prove creditworthiness.
How do authorized users affect credit scores?
Adding someone as an authorized user can boost their score by inheriting the primary holder's payment history and account age. But if the primary holder misses payments, the authorized user's score gets destroyed too. It's credit score roulette based on someone else's financial behavior.
What's the biggest algorithmic mystery in credit scoring?
Why identical financial profiles can have different scores. Two people with the same income, same payment history, same utilization can have scores that differ by 50+ points. The algorithm considers variables nobody talks about: geographic location, spending patterns, account types, timing of payments within the month.
How accurate are credit reports?
Studies show 20% of consumers have errors on their credit reports significant enough to affect their scores. Wrong payment dates, accounts that aren't theirs, paid-off debts showing as outstanding. The system is built on flawed data but treated as mathematical truth by lenders.
What's the dispute process like?
Kafkaesque nightmare. You dispute an error, the bureau sends it to the creditor who reported it. They have 30 days to investigate. If they don't respond, the error stays. If they confirm it's wrong, it gets removed. If they claim it's accurate, it stays and you're sole. The burden of proof is on you to prove a negative.
How do credit repair companies work?
They dispute everything on your report hoping something sticks. Most charge monthly fees to do what you can do for free. Some use questionable tactics like disputing accurate information repeatedly until creditors stop responding. It's largely a scam industry preying on people desperate to fix their scores.
Final question. What's the most dangerous misconception about credit scores?
That they measure financial responsibility. Credit scores measure how profitable you are to lenders. Someone drowning in debt but making minimum payments has a higher score than someone who pays cash for everything. It's not a report card on your finances, it's a profit prediction algorithm.
That you can game the system with tricks. People obsess over utilization timing, credit mix optimization, inquiry spacing. But the fundamental truth is that credit scores exist to extract profit from consumers. You can't optimize your way out of a system designed to exploit you.
Jesus Christ. So we've created an algorithmic overlord that judges humans based on their profit potential to banks, punishes financial responsibility, and operates with dozens of secret formulas that nobody fully understands. This is fine.
Welcome to modern finance. We've automated discrimination, mathematized exploitation, and called it consumer protection. The algorithm is the perfect scapegoat. It's not personal, it's just math.
This episode was brought to you by FinancePanic, where we reverse engineer the financial algorithms that control your life. Because understanding why a computer thinks you're unprofitable is probably important. We're back, let's talk about the practical nightmare of actually managing your credit score. Alex, what's the most absurd behavior you've seen people adopt?
People timing their credit card payments to optimize utilization ratios. They'll pay most of their balance before the statement closes, but leave a small amount to show utilization. It's like performing a ritual dance for an algorithmic god. The fact that this works proves how broken the system is.
The manufactured spending obsession. People buy gift cards with credit cards just to increase their payment history and utilization patterns. They're creating fake financial activity to fool an algorithm that's supposed to measure real financial behavior. It's completely circular.
And the authorized user farms. Companies sell spots as authorized users on high-limit, low-utilization accounts to boost people's scores. It's literally commercializing credit score gaming. We created a system so arbitrary that paying strangers to pretend you're related to them actually works.
What about credit monitoring services? Are they helping or just creating more anxiety?
They're monetizing anxiety. Most send alerts for normal score fluctuations that don't matter. Your score drops 3 points because your statement balance changed. Alert, you get a new credit card. Alert. They're training people to obsess over meaningless variations in an already meaningless number.
Plus, they often show Vantage scores while lenders use FICO scores. People think they're monitoring their real score, but they're watching a completely different algorithm. It's like studying for the wrong test while paying monthly fees for the privilege.
The identity theft protection is mostly theater too. By the time fraudulent accounts show up on your credit report, the damage is done. Real identity theft protection happens at the account level, not the credit report level. But credit monitoring sounds more valuable than account monitoring.
What keeps you up at night about credit scoring?
That it's becoming the social credit system nobody voted for. Landlords check credit scores, employers check credit scores, insurance companies use credit-based insurance scores. A number designed to predict loan profitability now determines where you can live and work. It's social control disguised as consumer protection.
The feedback loop's getting worse. As more decisions depend on credit scores, the stakes get higher, so people modify their behavior more extremely to game the system. We're creating a society where financial performance art becomes more important than actual financial health.
That we're automating bias at scale. The algorithm learns from historical lending patterns that reflect decades of discriminatory practices. It mathematizes inequality and calls it objective. We've created artificial intelligence that perpetuates human prejudice, but hides behind statistical complexity.
Any advice for people trapped in the credit score matrix?
Play the game minimally. Keep a few old cards open with small balances, pay everything on time, don't obsess over minor fluctuations. The score is a tool, not a report card on your worth as a human. Focus on building actual wealth, not optimizing an arbitrary number.
Check your reports annually for errors, but don't monitor constantly. Understand that the system is designed to keep you engaged with credit products. The best credit score strategy is often the most boring one-time inconsistency, not optimization tricks.
Remember that credit scores are correlation, not causation. A high score doesn't make you financially responsible, and a low score doesn't make you irresponsible. It's just one data point in a complex financial life. Don't let an algorithm define your self-worth.
This has been FinancePanic. We've learned that credit scores optimize for lender profit, not financial health, operate through dozens of secret algorithms nobody fully understands, and have become the social credit system that now controls where you can live and work. Sweet dreams.
Thanks for the algorithmic existential crisis, David. Now I'm going back to explaining to people why paying off their debt made their score drop and pretending that makes sense.
And I need to figure out how to tell my research subjects that their financial responsibility is mathematically indistinguishable from risk, according to the algorithm they're being judged by.
Keep questioning, keep researching, keep panicking. The future of financial freedom depends on people understanding how badly they're being judged by systems designed to profit from their confusion.
This has been FinancePanic, where credit algorithms meet human reality. Until next time, remember, your credit score owns your life, but at least now you know why the algorithm thinks you're unprofitable.